Thanks, Greg. Well, I think Sartaj is fully asleep on his computer keyboard right now because the number of people that are needing assistance are stacking up. Me and Reed are laughing. Reed fell asleep on his laptop earlier, and I fell asleep in the midday review. So things are great. 33 minutes from now, I gotta remember to reboot that oil room. Can't forget. Mind you, we might be done in 33 minutes. This one will be fairly quick, I think. Yeah, it's crazy. We've been falling asleep a lot. But we do have assistance coming. Actually, hold on 2 seconds here. It takes a lot more work to get this started than we thought. We were like, oh, well, we'll just retire and have a trading room part-time and have fun on the beach. And no, that's not what happened. That's okay. It's good. It's happy. I'm going to go visit the fish soon. Look at that gold, it's right up against there. Okay, so this is 2:05 p.m. August 31st, 2017, final masterclass, unless we get distracted with trading or something. I'm not even going to do a review of all the other sessions. I think we did about 20 sessions or something. No, 14, 15. What am I talking about? Some of them were extra long, so they'll probably end up being 20 sessions by the time we carve it all out. This is just the dry run. What I want to do is I want to give you a primer on Generation 2, 3, and 4 modeling. Generation 1, the gold algo is a good example of Generation 1. Yeah, it's a good example. If I do say so myself. So we did go through the process of how to set fibs so that you get these diagonal trend lines, and that's kind of the first step. So you'd have to go back in the videos and see that. I'm going to send out a bunch of videos tonight, by the way. So that's part of step one, and then it becomes a matter of which time frame does price react to best when you get these quadrants done, because when you set up your fibs, your horizontal fibs, and you have your trend lines set up, you end up with these quadrants, and then you also end up with that's just the alarm anyway. Then you also end up with what I call grays, which give you wider range support and resistance, and that's incredibly predictable. Like if you always want to win and just never lose, go to our algorithm models, go to the gray lines, these ones, and use them as your trade for support and resistance. Now you'll see here, like it screws around the gray here, so you'd get chopped up there, but you can just wait for it to confirm, right? So where does it confirm? Well, it gets up over the gray, it gets the red here, and then boom, it took off. Here it kind of took off, but even there's a trade, right? You just cut flat or whatever, because you're getting the power zone above and below the grays, and you want to be in the power zones. So PT, RR, price trigger, power, trade, risk, reward. Anyway, the grays are where it's at now, and that's on all the models. So I showed you how to set your fibs, and then you end up with these quads, and then you end up with the grays that become really predictable. On the gold chart, these blues are actually conventional trend lines that run through, that give support and resistance. I think gold was modeled on a 60-minute, I can't remember. It doesn't really matter either way because it works. This thicker line here, I think, is maybe off a daily. So if you get two different time frames going that respond, you can put them both on, and that's what gold has. And that wider range, I think it's the daily, has proven to be, a really good trend line overall, and the other ones have been proven to be kind of tighter time frames, and that's one way to do it. And then the other thing that you can do is you can get these clusters of resistance and support, and you can see how price got into the cluster. It struggled a little bit, but it regained this trend line, and then once it got out of the cluster, boom. And the cluster is just different areas of support and resistance that all cluster together, and that's what we call clusters. And on some of the charts we'll do, we'll gray it in to kind of help our traders know. By the way, in the oil trading, I gotta tell you, like, they're getting so good at using the model that they really, it's rare that I ever see a lose. Like, it's just win, 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 win. They just don't stop winning. It's crazy. So these are getting really predictable. And of course, as people are working on them, they're getting much more so over time, right? This yellow line here, what this is this would be part of second generation. What that is that's a calculated support and resistance based on math. And so second generation starts to include things like math calculations instead of just the actual model. These vertical lines here that these targets are on, those are math calculated where there tends to be, at that time of day or at that time of the week, there tends to be considerable decisions, and you'll see certain things happen with the price that are typically fairly aggressive. Now here it happened right before that time. Here it didn't happen at all. But this one's early in its development, the gold one. So these targets weren't hitting. The targets themselves are calculated. So when you get into the targets, when you get into these verticals, so when you get into these yellow lines, they're all, and if you think about it, there's horizontal calculated, there's vertical calculated based on days of the week or weeks, and then there's these targets. Now, so a lot of people will say to me, so where does that all come from? Where that comes from, and I'm mixing generation 2, 3, and 4 all in one batch here intentionally, because it all becomes a process of other indicators and what can help with your trade. But these are all, like on the gold chart, all in development, right? So I'll show you an epic chart right away to give you an idea of a model that's completely built out. But and then these purple arrows, those are just decisions of the actual channels. So beyond having the quadrants, the intraday quadrants, the wider quadrants, different times that are important, resistance clusters that are important, then it becomes channels that are important. Is gold going to continue up this channel once it gets out of this quad, or is it going to go down this channel as it gets out of the quad? Because the quads end up creating channels. They can be 2 or 3 quads wide. It depends on, or one quad. It depends on the time frame that you have your quads built on, right? And then it becomes, well, how does this help you? Well, every one of those quad lines is support and resistance. There's ways that pricing reacts inside of the quads when it gets to the quad walls, when it gets even to the midline of the quads, when it gets to those grays I was talking about. Here, you can see how there's major resistance and support, and when it gets to the decisions of the quads to go up channel or down channel, when your model gets predictable enough that you have targets that get hit all the time. So depending on where trade is in a quadrant, whether it's near the midline, whether it's in the inverse apex, or in the apex, or on the sides, or at the quad walls, those are all important areas. Gold's a little bit more unpredictable than most, but that's really how the majority of them are done, right? So, and the best way to understand the different indicators is to go to an Epic newsletter. go to our blog on our website on compoundtrading.com, go to one of the old Epic newsletters, and you'll see all the different kind of standard ways. Speaking of Epic, so I'll show you what Epic looks like really quick, just in case you haven't seen them. So yeah, all of those things that I just kind of pointed out there, those are all calculations. So of how we calculate them, it's impossible to do in short. Like that's a totally, you're into math land, forever land. It just, yeah, because basically what we're doing is we're figuring out certain times of the day that certain targets will hit in certain ways. All of it becomes chart history, running the math on the charts, and that I just can't teach you. It's something that can be taught, but it's something that gets so in depth and it takes so long that for the sake of conventional modeling, like to get models up and going, and well, from that perspective, it takes so much time. But in different equities, different currencies, different commodities, those targets, those vertical lines, like all those things that I just explained, they, beyond the generation 1 model, they'll change between different commodities, currencies, and equities. So I can explain it for oil, but it won't really help you for natural gas or for this or for that. But anybody that gets involved in modeling with us, like Reed, for example, his Bitcoin model is a generation 1 model, and we're going to be working with him on generation 2, 3, and 4, and 5. And but that it starts to involve hundreds of hours, if not thousands of hours. But at least hundreds of hours. It's not something that could be done in 20 sessions, like say 20 hours of teaching. It's something that is at least 200 hours long, if not more, because it becomes massive calculations. And what you're looking for is you're looking for consistencies or anomalies in the chart, is how it works. And that's all done through back testing, historic, and math. So getting to the Epic chart really quick. So this is an example of the grays, right? And on the Epic chart, they're very predictable. Price got into the gray just now. Bernard in the oil room shorted right there, and then boom, covered here. By the way, these purple lines, those are previous historical support and resistance. The other horizontal lines, sorry, are fibs, and you just have to go back in the videos to see how we set all those up. But the important part that I wanted to get at on the Epic chart is that the way Epics worked out is that there's 4 quadrants together, but they form one main bigger quadrant, and that becomes the channel. So this is the bottom of the channel, this is the top of the channel, this is the midline of that channel. So you can see how oil moved up the channel here. I'll show you. Takes a minute to get this chart moving here. Oh, I'm so happy I finally got somebody to set up all the new computers. And, that's an example, right? It's going to probably be 40 hours of work to get all my stuff. Well, probably more than 40 hours. And there's just no way I can't find 40 hours. So, it was coming down channel here. So this was the top of the channel, this was the bottom of the channel, this was mid channel. So oil was traveling down the channel, and it hit the bottom of the channel, and then it reversed and it went up. So now it's going up a channel. So this is an example of how, so you can see how it hit the decision wall here, whether or not it was going to continue down channel or reverse and go up channel. And what's really important is that you put a conventional chart beside this and trade with your conventional chart. All the good traders that use these models, I'll tell you, the two charts work together. It's just that this this and that chart become a predictable way to trade. Yeah. Now, the important thing is what's different about the Epic chart from the gold chart is that the Epic chart has these four together that become the channels, and then there's like a test wall, right? There's this and then the outside, so it's like a baseball field. And to explain how we got that is near impossible. That took over 4,000 hours of work and math back testing to figure out that the four quads go together and blah blah blah. And you can go on our YouTube channel and you'll see that we have smaller quads too, smaller intraday quads, and to figure out how all those go into these quads, because you know inside of here there'd be like 15 little intraday quads. It's a crazy math warp, but it's all Fibonacci related. But if you really want to dig into like generation 2, 3, 4, and 5, these are the kind of things you go into. But because it takes hundreds of hours to explain and you can't transfer that to the next model, there's no reason to put it into the masterclass series. The idea is just to explain to you that we've done it, it works, and if you start to model out beyond a first generation model, we can help you know, with those next generations. With Epic, you know, we've got the targets, and then we've also got the cluster areas, and then, but this is an example of generation 2, 3, 4, 5 in that, you know, these two lines are so close together. There's quadrants even in here, you know, intraday quadrants, and so you'd have to go to, you know, our YouTube channel to see the video on that, but I may as well get it on here really quick. I'll show you. And I'd love to be able to, you know, take the time or you know, explain it inside of a session, you know, to give you a better idea of how you would do that. Sorry, I'm cracking a beer. It's beer time. I'm going to take a, I am pooped. They changed all this, eh? Buggers. Maybe Sartaj did that, and that's just a different layout. So let's go to compound trading here. I'm going to get all these videos up tonight that I'm behind on. I'm so behind. So in here, playlists, compound trading. I'll tell you, there's some gold that's coming on these videos that anybody that wants to learn how to trade, man, there's been some good stuff. It's just that it's all raw, right? So people have to sit through it. But, you know, it's just another part of time, right? Like, it takes time to do all this, man. It's crazy. So we might be able to here review large oil trade. It's one of these because you see how the little green, those green ones, those are in the those are intraday quadrants, smaller intraday quadrants. Anyway, they're just the point of showing you that is just to show you. There's, see those there. Those are smaller quads inside of the quads I just showed you. And the purpose of just showing you right now is that that to explain that these, you know, this gets very precise. This isn't, you know, kind of random charting science. But anyway, you'd have to go, you know, go through all the videos, et cetera, et cetera. I just wanted to point out that that is in fact third, second, fourth generation. After you've got a first generation modeled, then we can work with you and help you out. And like I said, I think there's 4,600 hours in an Epic model, something like that. The gold model, you know, there's less than 400 hours in it. So I know Chris is working on a model right now for natural gas, and I think he said he had over 100 hours in it a couple of weeks ago when he had first started working on it. So Reed, I don't know, he's got many hundreds of hours in his Bitcoin model. But I'm going to take that Bitcoin one to the next level, second, third, and fourth generation. So you can see how they look different, right? Like here's the gold one. It's, you know, it's first generation. Another example, and I just wanted to, you know, give you a few examples of how these get so different, is the S&P model. The S&P model, we never were able to get the quads on it. What ended up happening here is that it's on 5 different time frames, but it works incredibly well, especially these grays. Like I got up over the gray today and boom. This green here is just, you know, showing our traders where the trading range is. But the way the S&P model has worked out is we weren't able, it's on 5 time frames, so you can't get perfect quads. The quads are all kinds of shapes depending on where the time frames collide. It's a crazy model, but it works. But it's the hardest to drive, to learn how to drive. But once you know how to drive it, man, and none of our models get viewed as much as the S&P model. It's when people are in it using it, like it has maybe 1/10 of the users of Epics and about 10 times the use. The guys that are using it are using it like crazy. It's so precise. It needs to go into the shop for some work. It's got some issues because Trading View, the charts, they move over time very slowly, and you know, it causes grief. But and once you know how to run that one, man, they're all the same that way. Once you know how to run them, but they all drive different, so they all require, because they're all modeled different. Now here's an example of something really interesting. So this is the dollar model. You know, I was on the intraday just fooling around with, you know, some quads on the 5-minute on top of an existing model, and the existing model had pardon me, this is the primary support that got lost recently, but it came ripping back, the dollar, and it had this as a possible trend line, and that's just a calculation of the typical trend line in the dollar. But what's really interesting about it is we calculated where it might happen, and we put that trend line on this chart. So look at this. This is August 28th at 6 p.m. We put that on the chart as a possible place for the dollar to regain the dollar over a year ago. And it happened. The dollar regained on August 29th, 4 p.m. Like imagine modeling that out, and then it gets in there. I mean, you can go back into our dollar chart and you'll see this a year ago. This green line right here has been on there for a year. So, and then not only did it, you know, so literally it's just a green line of the typical trajectory of, you know, a trend line on the dollar. So we had calculated where it should re-enter, and we had calculated what the typical trajectory is on average, right? It's like an elastic band. Trade will go up and down and up and down and up and down. But that should be the trajectory once the dollar regains. And we missed it by whatever that is. That's 18 hours or 20 hours or whatever that is. But that was done a year ago, and we missed it by, you know, 18 hours or whatever. So I'm pretty proud of that. That's why I got so excited about the fact that oil had re-entered, and it happened to re-enter right where we had calculated that did re-enter. That's where it would re-enter. And you'd have to look at the wider chart to understand. But these quads here, they might not even be right. They're not tested at all. It's modeling on the fly, and we have a video on that, so you guys can look at it. I don't think these are right, these 5-minute ones on here. But anyway, going to the dollar model to give you an idea of how different these models can be. So you've seen the S&P, you've seen the gold, you've seen the oil one, right? And they're all different from each other, but they all start at the same place. And so we've shown you how to do that, where you start at the one place, which is, you know, getting the basic quads together, right? Well, if you go to the dollar algorithm and you think to yourself, okay, the gold, the problem with the dollar one is I actually can't search it. There's like something wrong with TradingView's search right now. There are so many people wanting to sign up right now, and Sartaj is asleep on his keyboard. And like they're getting mad. They keep emailing and DMing me, and it's just like crazy. And they're like, "What do you mean you guys don't have time?" Just like, and I don't want to say, "Well, Sartaj is asleep on his keyboard," and Reed is Reed fell asleep on his, and I fell asleep during midday review. This is retarded. It's completely retarded. Anyway, here comes the dollar one. Oil has to be rebooting in 7 minutes. I have a feeling I'm the only one that finds that all funny. But even the kids, the youngsters, Sartaj and Reader, have a hard time keeping up with me. I'm twice their age. I'm 50 years old, 49 years old. So here's what the dollar looks like. See the difference? Gold, right? Diamonds. S&P is different in and of itself. That's gold. That's the dollar on, you know, intraday. And there's the dollar. Crazy, eh? Now it drives different. It's triangles. So you go up there, go down here, go down there. See, it's a triangle. It's a triangle. It's a whole bunch of triangles. You watch that video of the mathematician. It's called The Mathematician That Broke Wall Street. The only thing he tells the interviewer is that it's geometric shapes. So the only secret that he'll give away to the interviewer on that TED Talk is that the models are built on shapes, geometric shapes. This particular one is triangles. Neat, eh? Anyway, I'm nerding out there. So literally, that's all I wanted to show you today. Volatility, we're starting to get a handle on volatility. It looks like it's going to be diamonds. The conventionals are working better than we thought they would. Natural gas, it's diamonds. But yeah, the dollar looks like that. This is where it dropped through right here, and this is that line. That trend line is actually part of a triangle. Is what that is. So you see that green line I showed you? That's what that is right there. Thanks, guys. Yeah, I'll reboot oil. And that's it. That's the end of masterclass. It's just to show you that there are different types. Once you get your basics down, you know, in any one of your models, your generation 1, then we'll start working with you with generation 2, 3, 4, 5. But even that dollar model they all started with diamonds. Even even the S&P started with those quad diamonds when we first started modeling it. And it looks like a mess, but it works like a charm. And it wouldn't be the #1 used model that we have as far as frequency if it didn't work like a charm. It works like a charm. Yeah, so that's it. That's all I had to tell you. Thanks for joining our dry run for the Masterclass series. If you guys are doing any modeling yourself and you need help, let me know. I'm going to be tackling some of the people that have already showed me models that they want help with. And I'm going to go reboot the oil room. I'm going to go enjoy the beach, and I'm going to leave the trading room on, and you guys have a great day.